Ladies and gentlemen, good day and welcome to Sigachi Industries Limited Q4 FY2024 conference call, hosted by Nuvama Wealth and coordinated by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ranveer Singh from the research team of Nuvama Wealth Management. Thank you, and over to you, Mr. Singh.
Thank you, Chorus team. So this call is being hosted by Nuvama Wealth and coordinated by Go India Advisors. I am Ranveer Singh from Nuvama Wealth research team. I welcome you all. We have with us senior management team of Sigachi Industries, Mr. Amit Raj Sinha, its Managing Director and CEO. Mr. O. Subbarami Reddy, its CFO, and Ms. Shreya Mitra is the company secretary. I now hand over the call to the management team for his opening remarks, and before the Q&A session starts, over to you, sir.
Thank you, Mr. Ranveer Singh. Good afternoon, ladies and gentlemen. Welcome to Sigachi Industries Limited Q4 and FY24 earnings conference call. I hope you had an opportunity to review the financial results and the investor presentations available on the exchange. FY24 marked significant progress for Sigachi as we expanded our product offerings and presence across regions. We have strategically expanded our MCC production by 7,200 metric tons per annum at Dahej and Jhagadia plants, bringing our total capacity to 21,000 metric tons per annum. MCC with its unique properties is vital across various industries, from pharma to cosmetics. We prioritize maintaining quality standards and specialize in tailored MCC solutions to meet diverse clients' needs. Let me begin by providing an overview of the business segments in which we operate. Sigachi primarily operates across three segments: the excipients, in that specifically MCC, the operation and management, and the API, leveraging 5 state-of-the-art manufacturing facilities in India. As highlighted, MCC stands as our core operating segment with a combined capacity of 21,000 MTPA. The volume of MCC witnessed notable year-on-year surge, increasing by 16.47% from 12,655 metric tons to 14,740 metric tons in FY24. Substantial growth was also observed in revenue from the MCC division, increasing by 15.83% to 301.5 crore from the earlier figure of 260.3 in FY23. Looking forward, we expect a gradual rise in the utilization of the recently added capacities. We anticipate that we will reach 50% by Q4 of FY25, further rising to 80% by FY26. With this capacity utilization enhancement, we expect further addition to the top line from the MCC or the excipient segment. The demand for MCC as an excipient remains substantial, with its quality and pricing being highly sought after in the pharmaceutical, the food, and the nutrition industries. The total addressable market opportunity as on date is in the range of $1.4 billion. It's estimated to be around $2 billion by 2031, and we are confident in a gradual scaling up to meet this demand. In FY25, we have allocated a capex of 15 crores for our MCC division plant located at Hyderabad. Furthermore, to broaden our product range, last year we have acquired 80% in Trimax Biosciences, incorporating API in our offerings. This strategic move provides us to capture a larger share of the pharmaceutical value chain. The synergies between our excipients and API offering hold significant potential for expanding our market share. While awaiting regulatory approval for Trimax products, Sigachi will serve non-regulated and semi-regulated markets before moving towards exporting to the regulated markets. We anticipate the API segment to achieve approximately a 25% margin EBITDA as we transition to catering to the regulated markets. To facilitate our growth plans, we have earmarked 60 crores for capex to expand the Trimax capacity by 150%, adding up nearly 150 KL, at the end of which the total capacity would be 250 KL. Additionally, our plans of establishing the CCS project at the Dahej facility is there which would enhance our product portfolio in the excipient section. The customer base for MCC and CCS are all complementary and overlap, including the potential overlap from the API customers. These products complement each other, and which is such a diverse portfolio, we anticipate capturing a larger portion of our customers' wallet. In the O&M segment, we have established partnerships with renowned entities such as Gujarat Alkalis, Aditya Birla Group, ONGC, Lords Chloro Alkali. The growth trajectory of the segment aligns with our objectives. We have recently added Adani Solar Power at Mundra to our client roster. We're confident in our abilities to maintain excellence in this segment. Moving forward, we see significant room for growth. Geographically, our expansion has been remarkable, extending our approach to encompass the Middle East through our strategic joint ventures. Our wholly owned subsidiary, Sigachi MENA Aggressive, has established partnership in the UAE with revenue potential to reach $54 million by FY29. Additionally, Sigachi Arabia, another subsidiary, has collaborated with Saudi National Projects Investment Limited with anticipated revenue of approximately $180 million in FY25. We will be exploring opportunities in the segment in which Sigachi operates, that is excipients, API, O&M, and certain opportunistic trading. We are committed to continuous improvement, focusing on enhancing our R&D capabilities and implementing cost-effective manufacturing processes. This is to maintain our position as a preferred manufacturer with the highest quality standards. I now invite Mr. O.S. Reddy to give you a brief on the financial performance. Over to you, Mr. Reddy.
Mr. Reddy, please go ahead with you.
Thank you, sir. Good afternoon, everyone. I am pleased to report a strong performance in Q4 FY24. Our operating income in Q4 FY24 surged by 43.78% year-on-year, reaching rupees 104.1 crores. EBITDA experienced a robust growth, rising by 33.6% year-on-year to 16.3 crores with a margin of 15.65%. Net profit also saw a significant growth, increasing by 108.22% year-on-year to 15.1 crores with a PAT margin of 14.6%. In FY24, our financial performance remained robust. Overall revenue saw a significant year-on-year growth of 32.08%, rising from 302 crores to 398.9 crores in FY24. Revenue from O&M grew 32.45% to 35.1 crore from 26.5 crores in FY23. EBITDA grew by 30.49% year-on-year to 76.6 crores with a margin of 19.2%. Net profits amounted to 57.2 crores, increasing by 31.19% year-on-year. PAT margin stood at 14.34%. We'd like to highlight a declining trend in our return on capital employed, primarily due to ongoing capacity expansion plans and increased capital work in progress. As of FY24, this capital work in process stood at 96.6 crores, and we expect that as we bag more O&M projects and once the expansion capacity comes out, gradually increase, ROC gradually will increase in future. We remain optimistic about the favorable impact of our growth initiatives in the coming years. As we continue with our strategic expansion initiatives, we are confident that unlocking economies of scale and enhancing operational efficiencies will be pivotal for our future success. These efforts underscore our committed to sustainable growth and delivering long-term value to our stakeholders. That concludes my updates, and now we can open the forum for question and answers. Please.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Harmanpreet Singh, an individual investor. Please go ahead.
Sir, actually, I joined the meeting a bit late, so could you please tell me the status of our expansion plans, at what stage we are, like MCC expansion?
Mr. Harmanpreet Singh, the expansion is all on track. The erection and commissioning is over. The product validation is at close. We are already at 10% capacity utilization as we move in this current month.
Okay. Thank you, sir.
Yeah. Thank you.
Thank you. Next question comes from the line of Munjal Shah, an individual investor. Please go ahead.
Thank you, sir. Thank you for the opportunity. Congratulations to the management for good numbers. Sir, my first question is regarding the gross margin. Sir, when we are comparing year-on-year, there has been a drastic decline of close to 7.5% on the gross margin basis. So that is my first question. Secondly, sir, there has also been a huge surge in the debtors. If you can just throw some light on that particular thing. And sir, when are we expecting the CCS facility to start progress on the CCS facility? So these are my three questions right now. Thank you.
Yeah. Thank you, Munjal Shah. This gross margin, not much. This thing declining. That's because of increased material pricing. There is a little, maybe around 5% variation is there when we compare to last year and this year. And gross margin, and that is because of gross margin is mainly on account of increased raw material prices. And debtors in certain countries, there are receivables are getting delayed, like Egypt, and also the turnover in the last few months, that is in last end of the month to this end of the year, that is higher sales are taking place. That is one of the reasons. These things will regularize in maybe in another 3-4 months or in next 6 months time. We are finding the customers also finding some of the alternate measures to release the amount at the earliest. And the third one is CCS. CCS project, anyway, now we are at to obtain now the regulatory licenses, and maybe we'll complete it by 1.5 years time. We can the CCS project will come into operation.
Yeah. Munjal Shah, I'll just add into what the CFO speaks. The environmental clearance for the CCS project is still not obtained. We have a situation where for the last 3 months, the authorities have not really sat on the table to have a meeting because of the impending elections. So everything is on a standstill in terms of decision making at the state level. So we are just helpless. We are waiting that the first week of June comes in, and hopefully we will have the committee meetings coming in and the state level decision making body taking decisions and giving us the EC for commencing the project.
Okay, sir. Sir, just coming back to the gross margin, sir, what can be the sustainable gross margin percentage considering the product mix we have?
So, Mr. Munjal, I'll just add in, one of the other reasons for a slight dip in the gross margin is on account of the API vertical building up some revenues. Because API vertical, we are just getting started and it's baby steps, naturally, the gross margins are not as healthy as what is there in the matured excipient vertical. So what we believe is, like I indicated in my opening message, that as we kind of reach out to the developed markets, the regulated markets, we should be, maturing ourselves at around 25% EBITDA for our API vertical in the developed markets.
Okay. Thank you, sir. So, sir, can we expect maybe the EBITDA margin and the gross margin to regulate in coming 2 quarters with capacity utilization expected to improve in the MCC division?
So capacity utilization of MCC will definitely improve. However, like the value of APIs are much more than the value of excipients, And if the value of APIs are going to make up a significant portion of our sales, there is going to be a slight hitch in terms of coming back to what we were 2 quarters back. But we are working to see how we can regularize this in the next 3 to 4 quarters.
Okay. Sir, and basically, what has been the volume in terms of API? So if there's any ballpark figure you can share, because in the presentation it has been only MCC and O&M. But if you're talking about scaling up API in the coming years, if you can just share certain information related to the API segment, it would be really helpful.
Sure, Mr. Munjal, not an issue. Our current capacities of the API are by virtue of the reactor capacities, and the current reactor capacities, what has been acquired is 100 KL. There has been, in the shareholder agreement, we have had a declaration and an agreement where we will together put in additional 150 KL of reactor capacity, adding up to total 250 KL. Now, by basic thumb rule, what it does imply is that this 250 KL should give us an added revenue of nearly 200 to 250 CR on an annual basis at 100% capacity utilization.
Okay.
So we are in the process of building up our capacity utilization for the installed 100 KL, and once we reach a certain figure, we will be kind of commencing the activities and the civil works and erection commissioning for the balance 150 KL of the reactor capacity.
Okay, sir, and what will be the current API capacity utilization for 100 KL, roughly, if you can just...
It's around 35-40%, sir.
Okay. And sir, what can be the optimum? So I know it cannot be 100%, but what can be the optimum utilization level for this 100 KL?
So I would say 80 to 85% is a very fair optimum utilization of the capacity. Considering that there are regulations to be met and the product changes do take time, 80-85% I think is a healthy mark for capacity utilization.
And sir, what can be the reasonable time for us to reach that 80 to 85%?
So it's a give and take wherein our focus should be: are we interested in increased capacity utilization, or are we interested in an increased capacity utilization by additional focus on developed markets? So our focus right now is to have a healthy mix of capacity utilization combined with a healthy mix of regulatory filings into the EU region and the US region. So this combination is only going to give us good yields. That is what is going to improve our gross margins in the APIs.
Okay. So then, sir, I think we must have a pipeline of DMF filings for the developed market. So
yes, DMF and the CEP filing, Certificate of Suitability to the EDQM for the European Union.
Okay. So if you can just put in a number of what is the pipeline currently? What products have we applied for the DMF approval?
Sir, at this moment, we have already filed 3 filings to the CEP. There are additional 4 to 5 filings which are slated for this current financial year to the CEP.
Okay. And sir, if you can just help in future, if you can just help with what is the pipeline. So basically, when you are building a pipeline of DMF, what is the approximate market size of the products for which we are applying? So it could be at least we can have a ballpark figure in mind of how we are progressing ahead in the API segment as well.
So Mr. Munjal, it's a complicated question to answer because the market size might not really be relevant. I might be looking at a niche segment where there are limited players or where I have a better competence than my competitors. So that might not really be the actual relevance in terms of selecting as to which product to go into. It's a combination of a lot of things which includes competence, the nicheness, the newness of the product, and of course the markets.
Okay, noted, sir. No, thank you so much for answering me patiently. I'll get back into the queue. Thank you.
Thank you, Mr. Munjal.
Thank you. Next question comes from the line of Nihal Shah with Prudent Broking. Please go ahead.
Am I audible?
Yes, Mr. Nihal.
Yes. So I had a question, like we have added about 2 new contracts in the O&M segment as well. So what would be the margin profile in that? And can we see employee costs going higher, like when we had the new ONGC contract as well, that went higher? So do we expect that to be the case with this as well?
So, Mr. Nihal, I believe the employee cost is going to be high because in the Middle East, the employee costs are substantially higher. That's number one. However, we believe a part of it will be offset by the increased revenue we have for our O&M.
Okay, so the margins would be lower than the current O&M contracts that we have, or it will be in line?
I believe it will be in line with what we are going, because, getting a business or getting into a business with lower margins is no big feat. You don't really need to plan for it. Our objective is that we kind of qualify and penetrate into businesses which give us a better profile margin.
Okay. And on the API front, so how is the competition scenario with China for like MCC and for the APIs as well that we have?
So in competition from China isn't there in the cellulose field, in the MCC field at this moment. We have our competitors primarily from the developed markets, that is US and Europe. China is not really there in the fray among the top 7 to 10 customer manufacturers. In terms of API, it's a complicated mix of N-1, N-2 stage and the product where you are selling. So China cannot be ruled out in terms of the value chain, but one has to properly strategize to see which way the sourcing and the manufacturing capabilities align with the cost proposition of what the customer wants.
Okay, so what is our main competitive edge? Like we have competition from the developed countries, we have competition from China. So where is it that we stand out in the crowd?
I mean, competitive edge for us in excipients is in terms of volume and scale. Competitive edge is, all this is there in the presentation, but nonetheless, competitive edge is in terms of assurity of supply. Because we have 5 facilities across in India, even in the COVID, there was continued supply to our customers across the globe. Competitive edge is in terms of sourcing the raw material from the FSC certified organizations, which are sustainable.
Okay, thank you. Thank you for answering.
Thank you. Thank you.
Thank you. Next question comes from the line of Kusha with Nivisha Investments. Please go ahead.
Hello, sir. Am I audible?
Yes, sir.
Hello. Yeah, yes, please. So I had a couple of questions. First, for the JV announced this physical year, which business segment of Sigachi will serve this region through the JV?
So our subsidiary Sigachi MENA is going to be the front end for serving all the needs of the JV partners in the GCC and Saudi Arabia.
Okay. The second question would be regarding the projection of $180 million in revenue by FY25. With the Sigachi Arabia JV and SNP, do we have the capacity to meet the demand? Could you please elaborate?
So we of course have the capacity to meet the demand. It is just that we have to see what are the kind of products the joint venture partner has envisaged in the breakup of the $180 million. Now, they are seeing this as an opportunity. We have to work out to see how much of it can be facilitated from our in-house facilities and what are the other products which will classify itself as opportunistic trading, sourcing and trading. So for this, we will have to work out and see what is it that can be catered from in-house and what is it that can be catered from our channel partners who are across the globe.
Okay. So last question would be, when will your API capacity ramp up and contribute to the revenue?
So in the last financial year, the gone by financial year, or rather I would say the first financial year of the acquisition, we have already had a sales turnover adding up to around 45 CR for the part of the year. So it has already added up to a reasonable level of capacity and capacity utilization of the 100 KL. So it's already coming in, sir.
Okay. Thank you, sir. That's from my side.
Thank you. Thank you, Mr. Kush.
Thank you. The next question comes from the line of Harmanpreet Singh, an individual investor. Please go ahead.
Hello.
Yes,
Hello.
Mr. Harman.
Hello. Yeah.
Sir, actually, I want to ask you that actually I was looking at the profit and loss, and I have seen that our profit and loss net profit decreased with last year, FY23. So could you explain what are the reasons for this and what we are doing to increase in FY25?
Yeah. Thank you, Mr. Amit Singh. Yeah, this is in absolute terms, there is this thing profit is 57.27 crores is the net profit for the financial year ending 2024, and previous year it was 43.53. And in terms of the percentage, as you said, there is a slight decline is there. In absolute terms, there is around 13.73 crores increase is there. In percentage terms, yeah. Yes.
Sir, actually, I was looking at you have uploaded in the exchange that it's saying that the total income for the period in FY24 is 4,112, and previously it was 4,146. So actually it has decreased, and it could be seen in the equity per share. Previously it was 1.35, and now it is 1.30.
Yeah, this is mainly there is an increase in material cost slightly. Because of that, there is a change.
No, I think there is some confusion. Mr. Harmanpreet Singh, could you just repeat what you said? I didn't get it. I think I missed something.
Sir, actually, I am looking at the profit and loss figure for total income for the period for FY24 is 4,112, and it was 4,346 in FY23. So I was asking what are the reasons for decrease in income and what we are doing in FY25 to increase our net income.
Sorry, Mr. Harmanpreet, what was the figure for FY23?
Sir, for FY23, it is 4,146. And earning per share was 1.35, and now it is earning per share is 1.30.
No, something is wrong.
Yeah, something is wrong. Harmanpreet Singh, just you can see the financials. In FY23, you are talking about revenue or only EPS?
Sir, actually, I am talking about total income for the period. In profit and loss, total income for the period is 4,146.
No, here the
Sir, actually, revenue in FY24 is 31749. Other income is 1157. So actually, at the end of the PL, it's saying that total income for the period is 4,112, which is a bit less than the last year, which was 4,146. And earning per share is 1.30. Last time it was 1.35.
No, you are talking about standalone or consolidated figures? Because nothing is matching.
Oh, actually, I am talking about the standalone.
Yeah. Standalone, the income is total revenue is 317.49 is the revenue from operations, and other income is 11.57.
Yes, sir.
And total is 329.07.
Yes, sir.
This is FY24.
Yes, sir.
And FY23, FY23 total income is 296.99.
Yes, sir. So, but I am talking about the total income for the period. At the end of P&L, total income for the period is 4,112, which was 4,146 last year.
Okay. That is profit, net profit. Okay.
Net profit, yes, sir.
What is your question, please?
Sir, actually, I'm asking what are the reasons for decrease in profit and what we are doing in FY25 to increase it. What are our plans?
That decrease is a very small amount. That is because of around 33.75 lakhs only. And this is on account of increased material prices.
Okay, sir.
And you have any question on EPS? EPS also you are asking.
Actually, I want to understand that what we are doing in FY25 so that our income increases on standalone basis.
FY25, definitely it will increase.
So what are the, like,
Standalone
could you
unconsolidated.
explain what are the steps, like, you are forcing material cost to coming down, or what? Actually, I want to understand what we are.
Capacities, yes. The increased capacities comes into operational. And with the increased capacities, there will not be much increase in overheads. Fixed overheads remain constant, and the capacities will increase, and profit also will increase in the FY2025.
Thank you. Thanks.
Yes, thank you. Thank you very much.
Thank you. Our next question comes from the line of Manav Vijay with MB Investments. Please go ahead.
Yes, thank you very much, sir. So first my question is regarding the NCP. So in FY24, against our capacity of 14,000 tons, we did around 14,700 tons. Now since this additional 7,000 tons has become operational, so what you mentioned in the opening remarks is that we should expect a 50% utilization for the year. Correct, sir?
Yeah.
Yes.
So,
In the increased capacity, we'll reach 50%.
By Q4.
Yes.
So 50% by Q4. So what will be the average for the full year?
That is very difficult to actually mathematically break it up. There are cycles of the product, and I think it would be inappropriate to have an average for the year because, the graph is not really straightforward. It's exponential. So it will be incorrect for us to have an average. What we believe is currently we are at 10% capacity utilization. Next month we should be better than this. By Q2 we should be better. And finally, by the time I touch Q4, we should be at averaging at a 50% on a quarterly basis.
Oh. Okay. So, sir, so the next question in this case would be regarding the average realization that we'd be having on MCC. So I believe that for the year, our average was around 2 lakh rupees per ton. Now, compared to FY23, I believe this number has come down. Is it possible for you to help us understand what, so let's say, what kind of number we expect for next year in terms of average realization?
Yeah, next year it will go up because last year we pushed our quantities because 14,740 is the total quantities we sold. Because of that, we have compromised little on pricing. But this year, it will definitely increase further. At least 5% increase would be there.
5%.
Because keeping in view of our coming expansion capacities, we wanted to grab the market, and in that process, we have pushed our products.
Oh, fair enough. Next question is regarding the O&M. So with around 36 crores of sales in FY24, what do we expect for FY25?
25, yeah, that is, we expect around, I don't know, it's a futuristic statement, but of course, we'll around some 50, 55, 50 to between 50 to 60 will be there.
Okay, so maybe around 40% kind of an increase, 50 to 55 crores is what you are saying.
Yes.
Okay. Sir, next is regarding the Trimax. So 45 crores is what you have done this year, with around, I believe, 35% kind of a utilization. Again, for FY25, what do you expect that company to do, API to do?
This year,
we are looking at an increased capacity. Yes, sir. Please continue. Sorry.
Yes, sir. This year, we are looking around 100 CR top line for this thing. Anyway, the capacity expansion, it may come up in the last quarter or so, or just we are thinking, keeping in view of the regulatory licenses, and we want our primary focus is on to enter into a regulator market.
Okay. But as far as this year is concerned, so you expect to run almost at full capacity. So roughly around 1 crore.
Yeah, 100, 120 would be there. It depends upon the pricing, the products what we manufacture and sell. That's why it ranges from 100 CR to 120 CR also. Around 100 CR we can.
And sir, on this 45 crores of sales from API, what kind of operating margins you would have made in 24?
In API right now, the margins are not that great. Gross margin is around 15-16% is there, and even the operating capacities are very low. And then now we are we are in the process of getting the orders from the good customers, launching the orders and all, but it takes time. As of now, this year, not a great margins are there.
Okay. And in FY25, when you scale this revenue of 45 to 100 or 120, at that number, what kind of operating margins are possible?
Yeah, we are expecting maybe around next year also it may not be that good, but later on in FY26 onwards, that would be good margins, would be in good percentage. Because FY25 we are just settling down, and then we wanted to enter into regulatory market. It takes even before in FY25 also we may sell mostly in domestic market, and few would be there in regulatory market. But FY26 onwards, it gives good margins. We are working for long-term good returns.
So the FY25 10 to 15% operating margin from the non-regular market, that number is possible?
FY25? FY25 is, it is operating margin is around 10-12%, or even right now we cannot really, because it depends upon the entry into the regulatory market, at least last quarter, one quarter, Q4 of the FY25. Yes, right now we cannot comment much on that. But FY26, definitely we'll, our plans are there to achieve good margins.
Sure. Okay. Next question is regarding the receivable. So we had 150 crores in the month of March 24. What that number would be currently, sir?
Can you repeat again? What is that? 150 crores?
So 150 crores is what we had receivable in March 24.
Yes.
What that number would be currently?
Currently it has realized, but most of the receivables are realized. But still, I think to settle down to 90 days collection period, it will take another 3 months. And then our plan is to reduce to around 70 days, 60 to 70 days, in a period of 6 to 8 months. 6 months.
Okay. Last question from my side. The goodwill amount is 55 crores compared to 44 crores in the month of September. So this additional 11 crores has come due to what, sir?
That is the revision. This goodwill, entire goodwill itself is purchased goodwill. We bought Trimac Biosciences. The fixed assets available in the books minus the consideration. That is the goodwill.
So, sir, you had done the transaction before, I would say before September 2023, and that is how 44 crores of goodwill had come on your books. Now, how this 44 crores has moved to 55 crores?
Yeah, can you please repeat it?
Sorry, sir.
Yeah. This is we have implemented this accounting for Ind AS. As for the Ind AS, the goodwill is coming to this figure, this latest figure, whatever it is, 50. The earlier goodwill is based upon normal Indian account, this Indian GAAP, and this we have revised to the Indian accounting standards, Ind AS.
Okay. So next year, this amount
it will not change. It will remain same.
It will remain same.
Yes.
Okay. Okay. Thank you and all the best, sir.
Yeah. Thank you.
Thank you. Next question comes from the line of Devanshu Kumar, an individual investor. Please go ahead.
Hello, guys. I'm audible? Yes, you are audible. So please go.
Thanks. First of all, congratulations for the great set of numbers. I think my question is primarily to understand, in the previous calls, you have given a guidance that by FY25, you will reach somewhere around the revenue of 600 crore. Is that guidance still intact?
Yeah, that is still there. We hope we'll reach this 600.
Okay.
Yeah. So, Divyanshu, these are the aspirational figures, and this is what inspires all of us to kind of keep that as our North Star and head towards it.
Yes.
Got it.
Correct.
I read somewhere in an article that the growth in MCC in worldwide is somewhere around 5 to 6% CAGR. But Sigachi is doing a 21% to 25% CAGR in revenue growth, right? And it's right now contributing 12% of your overall revenue. Now, I would like to understand 3 years down the line, what will be the mix of revenue coming from API versus MCC, given the fact that MCC CAGR growth is muted worldwide. So I believe your growth will primarily come from API front. MCC will come, I think, provided you gain market share, something like that.
So, Divyanshu, so your answer can be, broken up into two different parts. First is 3 years hence, the revenue mix. That's a very difficult question to answer. It's like asking, the future, crystal ball. However, not denying the fact that we are growing at a 33% CAGR, our objective is to capture markets, whether it is in the API or whether it is in the excipients or the MCC. Now, in the MCC, if you go into the details of transactions of the market leader, I'll just give you a last 4 years brief of the world number one player. The world number one player historically for the last 40 years was FMC Corporation, a US-based company, Philadelphia-based company. 4 years back, it got sold to DuPont. DuPont had the portfolio for a year and a half or 2 years, and from that, the whole portfolio moved on to IFF, International Flavors and Fragrances, a French company. The French company, after taking it, realized that the fit was not the best. They were not really aligning with complementarity of their own products and the new products what they bought out. Just around 8 months back or 8 or 10 months back, the whole portfolio of FMC was again sold from IFF to another family-owned company in France by the name of Roque. They are among the leaders in ingredients. So what has effectively happened is that the market leader has had a loss of direction, and everybody else who has had capacities, qualities, regulatory approvals, and acceptance in the international markets have been capturing. So this kind of, and of course, they were at a very premium price, and because of that premium price, we could give a differentiated pricing to our customers, and our customers were more than happy to have a change, because we gave everything else what they wanted in terms of documentation and gave them a discounted price. They came in very well, and that is how we have been having market share much more than the growth of the MCC market itself. Did I explain it to your comfort, Divyanshu?
Yeah, thanks, Amit. So my next question is again the same line. You said by 2031, MCC market will be somewhere around $2 billion, right?
Yes.
Yeah. Okay. What is our current market share, and what do you basically aspire to do in 1 to 2 years? Because you were just saying that the other competitor is just losing the direction of strategy, and we are constantly gaining market share. So can you just give us a light of how much you can gain over the period of time? It can be 1 year also, but I just want to have your direction in place.
Yeah. So because we have installed capacity of 21,000 tons, I believe we can comfortably be touching a 90% capacity utilization of this 21,000 tons, and we should be gaining. By the time we start touching 75-80%, the CFO would be coming back to the drawing board to see how we can have additional capex for funding additional growth of the same product, because we don't really want to be in a situation where we starve our customers of our own products. So I believe we are very much on track, and we will gain market share as we move ahead, touching our 21,000 tons installed capacity.
Okay, but I think you didn't answer what is the current market share in the world right now for us.
MCC, there is the concept of market share isn't there, sir. MCC is calculated on the capacities of the manufacturer.
Okay, so let's say you will reach 21,000 capacity. What is the capacity of number one player, like you said, DuPont? How much is that? You have an idea?
Yeah. It is estimated to be around 50 to 55,000 tons per annum.
Okay, that makes sense. Good. Thanks. I think thanks for the explanation, and I wish you all the best for the upcoming results.
Thank you, Devanshu. Thank you.
Thank you. Next question comes from the line of Ankur Savaria with Equity Master. Please go ahead.
Good evening, everyone. I'm very happy with the set of numbers that you've given, sir, and you are doing what you have been talking for the last 2 to 3 years. My question is, even though we have increased our sales in different verticals, Q on Q, why have our top line decreased? Even though marginally, but it should have increased, sir.
So thank you very much, Ankur, for your kind words. It pleases us that somebody appreciates us. Not everybody is critical. So thank you very much for that once again. So, the Q3 to Q4, of course, there is a marginal drop. And that is just to tell you that, we are not God and we are humans like all of us. And sometimes things go beyond our control in spite of our best efforts, and we still miss what we intend to do.
But sir, what would have been the reason? Was the drop in the NCC, or what was the reason, sir? Because our capacity has increased and
right.
It should have gone up.
Yes. So in the Q3, we had good sales of API to our select customers. The select customers, as per schedule, whatever was the credit limit assigned to them, they had not paid up. And because the credit limit was assigned to them and they had not paid up, we held back sales.
Okay, so that means we have inventory is more right now and sales will show up in the next quarter or so. Am I correct in assuming that?
Absolutely. Yes.
Okay. Sir, one more critical question for the investors is that our stock was doing perfectly fine, or let's say doing over the top. I would really like you to throw some light on the Cater Field Global DMCC. Are they still in the preferential share allotment? What is happening, sir? We would like more clarification from you regarding the same.
So we have had no intimation from any of our investors who have participated in the press cap race that there will be any stall. Whatever is the media frenzy, it is only media frenzy. Everything remains on track, and we don't see any hiccups in terms of pullback of what has been paid.
Okay, so they would still be a part of the preferential allotment that was...
Yes, very much.
My last question to you, sir, is that we have been doing an excellent stock sales growth compounded year on year and for last 3 years or 5 years, let me say. What do you think for next 2 to 3 years? Would the 30% sales growth still be intact, or till what year do you think this will remain the same, sir?
So, Devanshu, my objective is to see that growth is paramount. Of course, protecting our margins, but growth is paramount. We keep conserving cash and we keep looking out for opportunities. Objective is to always be at a growth which is higher than 33% CAGR. Objective remains that, and for that we keep working around to see which are complementary products in place, where there are opportunities in place, where there are growth markets coming in, and expand into geographies, markets, products accordingly. Of course, protecting our core business.
Absolutely. And you are still hopeful that 33% is still achievable for the next, because as the revenue increases, to increase the percentage at the same rate becomes all the more difficult, because if in case you are a small company, growth can be taken forward when we have small sales. But now since the sales are getting
bigger and bigger, still the same percentage of sales increase would be tougher. Am I correct?
Yes, you're right, Ankur. The good point is, as we grow bigger and bigger, our brand equity goes up. We are able to employ better people who are better than us, and who get us a better sense of direction, get us market, get us better technicalities, improve our competence. Many years back, we were not able to employ costly people. Today, we can do that. So our level of competence also goes up, and that kind of accelerates the way we work towards ensuring that our CAGR doesn't drop.
Makes sense, sir. I really congratulate you once again for excellent numbers over the last 4 years, and all the best on my side.
Thanks a lot, Ankur.
Thank you. Next question comes from the line of Shivaji Mehta, an individual investor. Please go ahead.
Hi, thank you for this opportunity. So just had a clarification. You had said you can do 250 crores of revenue on the 250 KL of capacity in API. Is that right?
Yes, on a basic thumb rule basis.
Right. And my second question is on the capex outlay. If you can give some guidance for FY25 and FY26.
25, 26 or 24, 25?
No, financial year 25. If you can give some guidance.
24, 25. 24, 25, there would be capex this one. Trimax, there is some amount would be there around 30 crores or so. Total 60 crores it is allocated to increase the capacity from existing 100 KL to 50 KL, and the 60 crores we need to spend. And out of which around 50% we can incur. And from CCS side, we can incur 30 crores. And for this one API, this Hyderabad plant, MCC, around 20 crores. Total 100 CR would be there in FY25. Capex.
Okay, and anything on FY26, or is that still too?
FY26, another the balance 30 crores for expansion of this Raichur plant, API, and for CCS, around 50 crores would be there. And around 80 to 90 crores would be there in FY26.
Great. Thanks a lot, and wishing you all the very best.
Thank you,
Mr. Mehta.
Thank you. Next question comes to the line of Ranveer Singh from Nuvama Wealth and Investment Limited. Please go ahead.
Yeah, thank you. So few questions. I think most of our questions are answered. But few clarity. In the Dahej facility, it seems that capacity utilization has dropped in this year. So any particular reason? Despite this drop, we have the total production have been good. But particular Dahej seems to have shown a lower capacity utilization. Am I right?
Yeah, this is because the expansion works are going on here. Because of that slight disturbances, and then that's why there is a only slight decrease. The production capacity
marginal
4,000. Yeah, marginal decrease.
Okay.
4,616, and this year it is 4,487. It's a small because of the expansion work.
And Jagadia has made up this.
That's right. Yeah, Jagadia has increased far more than what it was slated to have.
Okay. And secondly, on your realization front, I think last year it was 208 rupees per kg. This time calculation comes around 185 rupees. Even if we assume that 5% increase happens as you were guiding, still that would be lower. So is this what?
This year it is around 204, 205 rupees per kg, not 185. Yeah.
Okay.
This is a small decrease because we pushed our products into the market, keeping in of the expanded capacities, so that we can grab the market, and then continuity will be there, and then because of there is a strategy for it. That is very
so while calculating this realization, we are considering only MCC revenue, right? We are not considering API or any other.
Yeah, API anyway we cannot consider because API the products ranges are different.
Yeah.
Because here we can calculate like this, but API we cannot calculate. Even no company calculates.
Yeah. And in API, the capex we planned, I think the Trimex we invested initially, how much it was, 100 crore?
It is total plant value is 125 crores for the 100 KL capacity. Right now, we have acquired 80% of the share for 100 crores. And the balance, 20%, we will acquire after 3 years.
And then after this acquisition?
Purchases call option is there. That is option.
Okay. And after this acquisition, we'll expand it to 250 KL.
Yeah, even before that also. The balance 20% shareholders also, they'll bring in equal amount. Proportionate amount for the capex expansion.
Okay. And the last one, that warrant, how much warrant has been converted or it is yet to be converted?
It is some warrants we have converted. Right now around 1.6. Almost 30% we have converted. 70% we yet to convert.
So that will get converted in FY25 fully?
Yes. FY25 fully, yes.
Okay. That's all from my side, and thanks a lot. It was a very good number and good call also.
Yeah, thank you, sir.
Thank you. Ladies and gentlemen, that was the last question for today. We have reached the end of question and answer session. I would now like to hand the conference over to Mr. Amit Raj Sinha for closing comments.
Thank you all for participating in this earnings con call. I hope we answered your questions satisfactorily and at the same time offered insight into our business. If you have any further questions or want to know more about the company, please do get in touch with our investor relations manager at Go India Advisors. Thank you one and all, and have a great evening.
Thank you. On behalf of Nuvama Wealth Management and Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.